there, I'm Lisa Doyle with Rockcliff Realtors, and I wanted to bring you a little bit of information about the market conditions right now. And so I brought a very special guest. Of course, Carole has joined us in the past. This is Carole Rodoni. She is the owner of a company called Bamboo Consulting, and Carole speaks all over the country, basically, about the economics, what's going on with our real estate markets and financial markets. She speaks, gosh, she spoke to groups all over the country. I think you've written books, yeah, articles, Wall Street Journal interviews, and
we call for the San Francisco Examiner on a weekly basis. So.
Very nice, very nice. Well, I've always respected your opinions about our economics and what we can anticipate. So, the biggest question that I get from clients right now is what's going on with the market? Why is what we experienced? Is there a bubble concern? So share a little bit about that.
Okay, let me start a little bit, first of all, with talking a little bit about the economy, because the economy is so important because it relates to real estate. And I want people to understand we really have two economies. You have a national economy, and then you have the San Francisco Bay Area economy. So national economy, just to give you a few statistics, I think GDP will be about 2.5%. That's not where it should be coming out of a recession, but it's probably the best we're going to get. And the reason why ours looks so much better than probably it really is because when you look at the rest of the world, you have China that came out today with terrible numbers. Japan is still in stagflation. You have Europe in a recession, and you have the Middle East on fire. So we look pretty good compared to the rest of the world. The stock market obviously has been absolutely stellar when you look at it. But way back in 2009, the Dow was down to 7,000. We're now at 15,200. People have gotten back 146% of everything that they lost. Both the Dow and NASDAQ are up for the year. We've had some minor corrections, but the big one that we had when Mr. Bernanke came out and said, oh my gosh, I might taper some of my buying, and eventually all this free interest has to go away. The world went crazy, of course, and we were down 700 points in 1 week. But when you look at that, that's only a 5% drop, and you're not even in a bear market until you get to 10, and it came back the next week. So the stock market has been wonderful this year. I think that basically when you look at where gold is not the place to be. The bond market, it went from 1.3 up to 2.6. I think that that's where it's going to be, probably almost 3% by the end of the year. So nationally, our economy is doing okay. We're coming out of it. It's slow, but we're moving forward, probably like kind of chugging along. The San Francisco Bay Area is on fire. When you look at it, San Francisco, 5.4% unemployment, less in San Mateo and Marin. You have a little bit more over in the East Bay, but still absolutely magnificent. First quarter, 33,000 new jobs created in San Francisco, 27,000 just in Silicon Valley. And when you think that in the whole nation we've had 150 to 200,000, we're carrying about 20% of the weight of all of that. And when you look at Silicon Valley, they can't hire enough people. Average pay down there now is $125,000 a person. When you look at San Francisco and all the rebirth that's going on, all the rebuilding that's going on, Apple's going to be building a new campus. Basically, Intel's going to be building a new campus. So here we live and move to a different drummer.
Right.
San Francisco is really an international city because one of the most visited places on the earth, you know that. Basically, we have Stanford and Cal, two world-famous institutions. We are the gateway to the Pacific Rim, cultural diversity, great employment diversity. You are 4 or 5 hours from everything and anything you'd ever want in your whole life. And basically, we have Silicon Valley, which is basically unknown to man any place else on the earth. So our economy here is better, and that's probably why our real estate market is the best in the nation.
Yeah.
Now, you asked me about this bubble.
Yes.
Well, I don't think we have a bubble. I think right now we have what I call a powerful market. Here's the difference. We did have a bubble. Let's go back to 2007 when anybody and anybody could get basically a loan.
Oh, exactly.
That's
With
what I call
down
a bubble.
And no money.
Yeah. And the reason why I call it a bubble is when you take something like real estate, which is an asset, and you artificially inflate it, and that's what they did. They made the values go up by giving everybody a free loan, basically nothing down. These people couldn't afford the terms and conditions. And so what happens when you artificially inflate something? After you blow it up, it bursts like a balloon, and it falls back on itself and goes flat. And that's exactly what happened. And we went from 5 million to 7 million people that were in the residential, let's go buy a house, day trading business. And what they all found out is that's not the kind of thing that you do with real estate. This one is different. Let's talk about it. Yes, you're getting multiple offers. Yes, 27% is all cash. But you have ready, willing, and very able buyers.
Yeah.
See, you have
Yeah, I'm sorry to interrupt. They are having to show that they can actually sustain the mortgage.
Right. Yeah. Not only that, they're paying cash.
Right.
These are people that are going to stay 5 to 7 years. They're not day trading. If you have investors, the investors are good investors.
Yeah.
They're either international or they're paying cash, or they're hedge funds now that are starting to get into the foreclosure short sale market. And a lot of them are going to hold these properties 3 to 5 years. They're not just necessarily spinning them.
Right.
And then they're taking advantage of the increase in rents, the basic idea that they get cash flow positive day one. And then they'll wait 3 or 5 years with the appreciation. They'll get the best of both worlds. So I call this a powerful market. Now here's the thing I think you need to understand about a powerful market. It's probably in its bloom and started probably 5 or 6 months ago. I think we're beginning to feel a tapering off, all right? And do you feel that, Lisa?
Oh yeah, definitely a cooling. It's like we've seen our inventory double in the last 30 days. Interest rates creeping up has caused a little bit of cool down, I think. I mean, you can share what you believe would cause the tapering.
I think not only the tapering came, but I think it's a great thing,
yeah.
and I'll tell you why. Because we had this frenetic market that was beginning to get a little bit out of control with 30, 40 offers on properties. That's ridiculous. And so at the end of the day, I think, one, interest rates going up probably made people step back. Now let me talk a minute about interest rates. Anybody who thinks 4% on a jumbo or 4.40% on a jumbo is astronomical interest rates, tell them to sit down and get a grip. Go on the Freddie or Fannie website and look back what's happened over the last 30 years. We've averaged 7%. I remember when interest rates were 15%. We all still bought houses. And then I remember when they were basically down to 12%, and we thought we had died and went to heaven.
Single digit, 9% was
yeah, I mean, unbelievable. So at the end of the day, 3.5%, 4.5%, you need to get in. That's the key, because what I can tell you is you've got a few more months of that, and I think it's going to be 3% on the 10-year note by basically the end of the year. And then what I think is going to happen is we are going to go back to more interest rates, and you're going to begin to see that 3 and 4 change to 4 and 5. So if you're a buyer,
change to 5 and 6, maybe,
yes. And so if you're a buyer and you think it's going the other way, let me just try to give you a prophecy and tell you stop already, because this free money is going to eventually stop. I think Mr. Bernanke is going to keep it low as long as he can, but I think early next year he's going to have to start to raise interest rates. I think interest rates have tapered our market, and that's been a good thing.
Yeah.
The other is that I think more people are willing to put their houses in the market now that they've seen appreciation, and they've seen multiple offers, and I think that has meant that there's more inventory and more choice for people, and that's a good thing. If you're a buyer, let me give you some of the things to consider. Understand what's affordable for you, because if you think you have $800,000 in cash, and right now you can go buy an $800,000 house, probably not going to happen, because we're still, 800 is basically the list price, but that may not be the market price.
We're still seeing multiple offers pushing
Yes.
prices, just not as aggressively
Not
as we
as
saw 2 months
aggressively.
ago.
So
Right.
you have to understand what you can afford. The second thing is, I love it when people say, well, I'm all cash. You know, there's different kinds of cash. There's liquid cash, which is in the bank, sitting there. You can go get a cashier's check today at 4 o'clock, and you have that money. Then there's mid-liquid cash, which is, oh, it's in the stock market. The stock market could go up and down one day, and your $800,000 might be worth $700,000. And then the illiquid cash is it's coming on a boat in a Louis Vuitton suitcase from someplace. We don't know exactly where. The government's going to stop it when it gets here, because it's a drug money, or was it terrorist money, and how is the money, where did you get it, who got it, who owns it, etc. So cash is nice, but what kind of cash is important? I think the main thing, however, is for these buyers to understand that list price may not be the right price, because people are basically pricing these homes 1 to 3% below where the market really is, and therefore you have to really work with an agent like Lisa, because they know where the market really is and where you need to start. And then Lisa, knowing how many bids have been coming in on similar properties, she can help you get into the competition of trying to win on these houses, because that's what you're really doing.
Well, especially in that mid-price range. You know, our market over $1 million, of course, is softer. You have more choices. You have more.
Right.
You know, you've got more time. That 600 to 800-ish range is
Tough.
pretty hot.
Very hot and very tough, and you need to understand how to play the game.
Right.
And if you don't want to do that, then you either need to wait out the market or go look someplace else, because it's the way that it is, and I think it's going to continue. It may taper a bit. So instead of 12 multiple offers, there'll be 5. But see, that doesn't change the fact that list versus market versus where you need to go to get a winning bid is going to be any different. It'll be just that it'll be a little bit less that you have to do it aggressively, but you're still going to have to play the game the same way, and I think they need to understand that.
And we've seen in our market, of course, our decline was about 30%. 30 to 36% in most neighborhoods.
Yes.
It's neighborhood sensitive. We've risen back about 22%
Yes,
of
you
that.
have.
So we made that 22% jump very quickly. And
Very.
now we're likely to see a rise that just is a little bit more, hopefully, more stable and not so crazy.
And that's a good thing.
That's a good thing.
The other thing that we're seeing now is, I think, really, instead of making offers and going back and forth and all these contingencies and things, you need to basically rely on someone like Lisa, who will tell you, we have to write a contract going in, which to me means it's 90% done on the first shot out of the hoop. Because if there's going to be multiple offers, what I'm going to tell you is agents are going to look at the strongest, best offers. That's the ones that are going to get the counter offers, or the one that's going to get the bid and going to get the one that wins. So you have to understand that. Some of the other things that we're seeing across the Bay is that what they're doing is they're increasing their deposits. And so that's one thing that may make a seller open their eyes. Wow, I got an increased deposit, shows the commitment of the buyer. And the other thing is that a lot of buyers are saying, look, I'm all cash, no financing, no appraisal contingency, I've increased my deposit, my offer's only going to be good till 4 o'clock tomorrow. Put a little pressure on the sellers. That can't hurt. You know, it's a good thing to do, because you don't want to be going back and forth and competing. And then sometimes they'll say, well, I want to wait because we're going to hear offers on Tuesday. Well, you just got the best offer that's coming in, because you know what's going to happen to you if you don't listen to that? Your AAA buyer's walking out the door. And can you afford to have somebody who has all cash, no financing, no appraisal, increase their deposit, basically can sign papers today at 4 o'clock? Are you that confident that somebody else is going to come in and be better than that, and that they're going to come in on Monday and do that? So you need to think about that, Mr. Seller.
I've had a few clients who, unfortunately, have done what you've said, opted to wait against my better judgment,
Yes.
and ended up selling for less. So
That's
you
right.
definitely want to be cautious
So
of that.
listen to your agents. Somebody like Lisa and her husband are so good at what they do on an ordinary market. But in this kind of a market, you definitely need to listen to them, because this isn't just, oh, well, let's go buy real estate. This is a market that requires strategy, positioning, and intelligent reasoning. And believe me, I know there's 5,000 websites out there. I know you read every article that's written, but believe me, you don't know the market.
Right.
Real estate can turn on a dime. It's an instant, momentous kind of thing. It's terribly emotional. And believe me, you need to do it every single day and live it in order to understand how you have to play this to win.
Well, and we can see the subtle changes coming
Yes.
before they actually hit. So yeah,
Yes.
it takes a close eye to really anticipate.
So I think over the next 3 to 5 years, that's going to be basically what I think is the time frame for this market. And here's what I think is going to happen. I think it's going to taper down, but in this area, it's still going to be good. I think we have a good market here. I think you're going to get the best of both worlds. I mean, and let me just try to tell people what I think is the magic of real estate. I think you can be in the stock market, you can be in gold, you can be in bonds, you can be in anything. But real estate right now is what I call the TINA. There is no other alternative right now, whether it's commercial or residential. And it's because of the low interest rates. That's why I'm telling you, get in now while you can. Let me give you an example. You bought a house for $600,000 in 2002, and you got a 25% down, 30-year fixed, and you paid 6 or 7%. Your payment's about $4,000 a month, and here's the way it goes at the bank every month. When you make that mortgage payment, 9% reduces the loan, and all the rest went to the bank in interest. Fast forward to today, same house, $600,000, hasn't appreciated one dime, but now you get the loan for 4.40%. Your payment's $1,000 less, and now when you make your mortgage payment, here's what's happened. 27% of that payment goes to pay down the loan. The rest goes to interest.
Wow.
What I just told you is you build wealth in real estate, because every month you're owning the difference at 9 over 27 every month. So in 3 to 5 years, if you both sold those houses, the person that had 27% go into equity walks away with wealth, a lot more than the person that only got 9% every month. That's why there is no other investment out there right now that can give you that kind of a return. So what I just told you is you build wealth, and it doesn't even have to appreciate. If it appreciates, you get
That's
the
just a
two-thirds.
bonus.
Yeah, you get the bonus.
Yeah.
So at the end of the day, 3 to 5 years, and here's what I think is going to happen. In the really hot areas, you probably will look back and you will have double-digit appreciation of some kind.
Yeah.
In the areas that came back a little bit slower, that went down further in the downturn, you're probably going to see some single-digit appreciation at the end of the day. But I think right now is really a sweet spot, because it's beginning to taper just a bit.
Yeah.
It's cooling down a little bit. It was frenetic. This is the best thing that could happen across the board, especially for us, because we are considered, quote unquote, the hottest real estate market in the nation. And just to tell you what that means, San Francisco, median average price now is bordering close to $1 million.
Crazy, isn't it?
That is absolutely unbelievable. Back already to where it was, and even beyond the peak in some areas.
Yeah.
So all I can say to people is, look, get good advice, listen to the real estate person that you work with, make sure that they understand how to work in this market, because I'm telling you, it's a great investment, but you need to know how to do it.
Yeah, I agree. And thank you, Carole, so much for sharing. Your knowledge is always so appreciated.
It's a pleasure.
Yeah, we'll come back and see you again in 6 months. We'll get an update.
Yeah, we'll see if we're right. I'm sure we are.
Thanks so much for tuning in. I'll talk to you soon.